All right, everybody. Hopefully, you guys are all tuned in. We'll go ahead and get started. I'm Colin Lazzuo. I'll be your host and moderator for the first of four ACFAS financial webinar series that we'll be holding for 2026. I'm joined here by Matt Becerra, who we were lucky to have him for our past 2026 ACFAS ASC. He was a big part of our Residence Day planning regarding financial literacy and kind of planning for the future. And yeah, he'll be here to kind of go through what of our, like I said, our first four series that we're going to be holding. Matt Becerra is a finance planner with Generational Finance Financial Partners. He specializes with working in physicians, helping them get their financial decisions with their personal and professional goals in mind. We're lucky to have him here, and yeah, we will start by kind of basically asset planning for today's session. We'll be going over different topics like disability, um, life insurance, real estate asset planning, and then our future topics that are to be determined. So stay tuned. We'll be transitioning to attending life, saving waterfall and student loan strategies. In our fourth and final session later in the year will be Roth IRAs, wealth team, or sorry, team long-term wealth building and benefit enrollment tips. So, with those in mind, Matt Becerra, I'll kick it off to you, man.
Awesome. Thank you, sir. And thank you, everybody, for joining us this evening, depending on where you are, different times, but super excited to be with you all. It was great to be at the ACFAS, conference a couple weeks ago. So for anybody who I saw, nice to see you again. And I will just kind of preface before I do start to dive into anything that this is very much your all's time. So we are going to talk about, different insurances. We're going to talk about emergency funds. We're going to talk about building a strong financial foundation as residents and as you transition to attendings. But I am going to encourage you guys to ask questions as we go. So if we need to chase a squirrel, that's awesome, and that's what we're here to do. But as Colin mentioned, my name is Matt Becerra. I'm a certified financial planner with Generational Financial Partners. We, as a firm, specialize in financial planning for physicians. So about 95% of the clients that we work with are physicians. A healthy chunk of those are 1099 independent contractors. Many of them are W-2. So we work with kind of the full spectrum of folks like you. And so, for today, this is this is not necessarily the most exciting piece of it. This is not going to be the sexiest part of your financial plan. But this is the part that helps to make sure that you are building on something sturdy and you don't have this really great investment portfolio that falls apart because you overlooked some of the relatively easy to plan for risks. And so I'm going to take a moment and just throw up on the screen the savings waterfall. If you were at the ACFAS meeting, you saw this already. We are going to have a whole session that will be geared towards going through all of the tiers of this financial waterfall. But for today, we're really focusing on tier one. And when I look at the waterfall, which there are many versions of this, right? We didn't invent it. This is not going to be something that's completely novel, but we're basically thinking about the prioritization of your dollars, right? As particularly, while in training, there's only so much that can be go around, and so you have to be thinking about money go. And so you might only be able to attend to tier one during residency. You might be able to, venture off into tier two, tier three, fill in the blank. But we really want to make sure that we are not overlooking, again, really obvious risks, really salient or clear risks. So, what is made up? What kind of comprises tier one is going to be insurance and protection planning. At large, that's going to be disability insurance, life insurance, umbrella coverage, maybe not during training, but shortly thereafter if you don't have it. And then we'll talk a little bit about legal planning, which is not going to be super well. And again, I make an assumption. If you are a single person as a resident, there's only so much that you'll be able to do and only that so much that'll be relevant. If you have a spouse who's working, who's making a healthy income now, and then you'll have a healthier income later, some of this stuff might actually be a little bit more on the nose for you. And I'll try to call that out as we go. Um, but we'll talk about the insurances and the legal planning. Emergency fund, relatively straightforward, but I do want to make sure that we understand the thought process behind it and not just say like, oh, 3 to 6 months of income, that's probably what I ought to have. And then we'll spend a little bit of time in those last two of employer matches and high interest debt. But that's sort of where we're going to live for today. Like I say, I'm happy to take questions, whether they are explicitly related to what I'm going through, or if they are just something that seems like it's on your mind and you want to ask it. This is again designed to be as valuable for the group that's here as it can be. Um, so with that, I will dive in. I'm going to leave this up for reference just for a bit. I'm going to start with life insurance because I think that it's a little bit more straightforward. It's applicable for some, but not all. But life insurance planning is really important if you have financial dependence. So in our work, we see that in a couple different categories. So sometimes it is more traditional. I've got a spouse, I've got kids. Those folks are dependent on your income. They will be dependent on your income throughout your working career. And so life insurance is really important. In other cases, we have folks who are supporting siblings, who are supporting parents. And, while that's not the kind of linear life insurance need on average, that's something where, if it's important to you and if your family members, friends, et cetera, are relying on it, you want to make sure that you're protecting it. So with life insurance, term life is going to be the tool that you will use, and 9 times out of 10, almost, I mean, I might say 99 out of 100 in residency or training. So term insurance is inexpensive life insurance where, you get to lock it in for a period of time. Now, what's important, and this is relevant for life and disability coverage, is as you mature in your career, and your assets go up, well, assets go up and future earnings potential goes down because you're experiencing it, your need for insurance goes down also. So during training and shortly thereafter are typically going to be the highest insurance need years that you will experience. With life insurance in particular, you will get some through work most often. That's valuable. It's not necessarily going to travel with you. So you need to think about, am I going to, I mean, almost everybody here is going to be changing roles at some point. So you don't want to rely on your employer sponsored coverage explicitly. And you just want to make sure you have enough. I think that's another thing that we run into. And I want to say physicians have gotten more up to speed than the general population with this stuff. But the number that you need in life insurance protection is big. If you think about how much future earnings potential you have and the fact that this life insurance is designed to replace your income for as long as you would have otherwise been earning it, that's going to be a pretty big multiplier. So it's not uncommon that we'll see this ranging in absolute dollars between about 2 million and 5 million of protection. During training, might be on the lower end of that. 1 to 2 million is oftentimes going to be sufficient, but term life is going to be comparatively inexpensive. So, you can kind of go into this and say, I need to check the box. I want to get it out of the way. And I think that's a perfectly fine way to approach it. Disability insurance is, another one, gets a lot of press in the physician community, right? You guys have probably been beaten over the head with it. But this one is really important. And so our my view, I think our firm's view is, you get solicited for this a lot, I would imagine. And the approach that a lot of folks take, I think, is wrong, but the message or the kind of thought behind it is not necessarily. So what I'm going to try to do today is I just want you to feel empowered in understanding what you need to be looking out for in a disability contract. Now, I will put a little asterisk. Disability coverage does vary slightly from state to state. Namely, California is like the most tricky, but there might be small contract differences depending on where you are. Um, but the kind of structure of what I'm about to share is true. Now, the other thing that I'll say is kind of unique to, podiatry is you're categorized sometimes differently than other physicians. And so while, your anesthesia friend might have a guardian policy because that's what's best for them, that might not necessarily be the case for you. And so I'll talk a little bit about that. Before I do, I want to talk about kind of categorically what are the things that you're looking for. And I'm going to pull this up for just a moment. This is a sample for a resident, in your field, and this will go through some of the core benefits of a disability policy. So just kind of running down the list, and again, I want to make sure that we understand what these things mean, and then we know what to look for more specifically. So your standard contract during residency is going to cover up to $5,000 of monthly benefit, regardless of how much income you make. So you can get a policy. It's typically simplified underwriting, so you don't have to jump through as many hoops medically. You don't have to really jump through any hoops financially. You don't have to prove how much income you're making. As a resident, you qualify for $5,000 a month with most carriers. The typical benefit period, which is how long the policy will pay from the time the claim starts, is to age 65. There are other benefit periods available. We don't see them used all that often. So this is going to say the benefits will be payable until age 65, regardless of when the claim starts. It starts when you're 30, it's 35 years. If it starts when you're 50, it's 15. Okay. There are 90-day elimination periods in most cases. So elimination periods is the amount of time from the point where the claim starts before the policy kicks in. This is sort of what differentiates long-term disability, which is what most people are pursuing here, versus short-term disability, which is typically an employer-sponsored benefit if you have it. And then this is going to be one of the more common riders. So this is usually an item that you pay for, but a cost of living adjustment. So cost of living adjustment is what it sounds like, but it says while you're on claim, your benefits will increase by, in this example, 3% every year to compensate for otherwise cost of living adjustments you would have got in wages. It does not do anything while you are healthy. Okay. So those are kind of the standard benefits. So 5,000 a month, benefit period to age 65, 90-day elim, 3% compound, cost of living. That's what any competent person who's giving you a quote will include. The things that you need to look out for, depending on who you choose to work with to pursue your disability coverage, are going to be these three, with a little asterisk next to that too. True own occupation. Okay. The definition of disability matters with your policy, with your private disability coverage. Now, the reason it matters is there's two prevailing definitions that are used in these contracts. There's own occupation and there's any occupation. So any occupation is going to be a definition that says broadly, if you become disabled, you are considered disabled if you can't do anything for which you have been reasonably trained or educated to do. Okay. Problem for physicians is you've gone through a lot of education and training. You could do a lot of things, and a lot of those things would not yield the incomes that you will get on the other side of your training. And so any occupation definitions are no good, broadly definitions say you are disabled if you can't do the job for which you are doing prior to the disability claim. And they're going to look at billing codes, they're going to look at job description, they're going to look at what you were actually doing. So what's also nice about this is it travels with you. If you take on specialties, if you start to do more tailored work, more specialized work, that definition will change in concept as your specialty becomes more nuanced. Okay. Now, the other thing that's part of these own occupation definitions that may or may not be part of the contracts is whether you can work in a job other than the one that is considered your own occupation without impacting benefits. Okay. So you all are doing your what you do every day, right? That's your job, your own occupation. If you become disabled and you can't do that anymore, that's one thing. But if that happens early in your career, are you on the couch for the rest of your working life and not do anything? And the answer for most people is probably not, right? You might go into consulting. You might have a complete change of vocation and do something completely outside of medicine. You might, again, 100 different examples of something you might do other than your own occupation. And so the question is this policy going to pay you if you're earning income in another occupation? Some of the contracts will, some of the contracts won't. It's not necessarily that you have to have one that does, although we would typically advocate for that. It's that you need to understand what your policy does and doesn't cover, right? Because this is going to be in fine print. This is not going to be on the cover page of your policy. It's in the definitions. And so you've got to go through that, or you've got to have somebody who's going to take you through that to make sure you understand how this thing works. Now, the other version of this, or the other part, is the residual or the partial benefits. So these are, again, typically paid for riders. These are cost items that you'll see. And the residual or the partial disability benefits is what if it's not a total disability? What if you can still work in your own occupation, but you can't do as many procedures, you can't see as many patients, you can't be as productive as you were prior to the disability? And so what we look at here is number one, how are they measuring it? And then what are the thresholds? So some common language that we see here that you want to look out for is whether there's small words in here. So ands or ors. Ands or ors is kind of how we describe it. So a lot of contracts are going to read that they're looking at income, loss of time, loss of duties. Okay, so those are three common features that are being measured, so to speak. Now, some of the contracts are going to say loss of time and income and duties. So I need to have a 20% loss of time, income, and duties. Other contracts are going to say I need to have a 20% loss of time, income, or duties. Okay, now one of those is going to be more favorable. The one that says or, it means that you have fewer hurdles that you have to prove in order to collect on your partial disability claim. The ones that say and are going to be a little bit more rigid. You've got to show that there's a time loss, an income loss, and a loss of duty. Okay. Not wrong. Neither one of these are wrong, but you want to know which one you have. You also want to know what the threshold is. So I use 20% as an example. That is fairly common. There are some that are 15, some that are 30. So you want to see, what does your policy cover? What doesn't it cover? And then the last thing that I'll say on the residual or the partial benefits is you want to look at any enhancements that are potentially available. Okay. So enhancements could be, for example, in the first 12 months, you will receive no less than 50% of your benefit. So even if you are 20% disabled, 20% hindered in terms of income loss, the contract might pay 50% of the benefits for a limited period of time. Okay. So this is important. Again, you just want to understand the nuances of the policy. And this is a good example. Not everybody needs a Cadillac, which I don't know that that's really a great example of a luxury car anymore, but that's how the saying goes. So not everybody needs a top tier disability contract, but you want to know whether you're buying, the Mercedes or the Chevy, right? Neither of them are wrong, but you want to know what you're getting. And then the last thing on the disability is the benefit increase provisions or the benefit increase options. So when you're in training, you get this $5,000 a month policy. It's great. And again, you should do it. Point blank, it's important. You get simplified underwriting, you get limited, you get access to these types of things. So, and your program, I should say, might have special discounts. So you always want to look into any special options through your program, whether it's guaranteed standard issue, meaning there's no medical questions, or whether there's a discount or not really applicable anymore, but sometimes there are unisex policies which benefit women significantly more. So you want to look into that. But you get this $5,000 a month benefit, which is great when you're in training, right? It's an affordable way to get your foot in the door. And with a lot of carriers, you can actually go lower. So if you just say, hey, I want to check the box, get a policy, lock in my insurability, which is what I'm about to talk about, you might be able to get a policy for $2,000 a month and keep your premium really low until you graduate and move into your attending role. Now, when you move into that attending role and your income goes up by three, four, five-fold, depending on, you're going to want to upgrade your disability contract. The $5,000 a month that you're getting as a resident no longer seems significant enough. And the benefit increase option or the future increase option, depending on how you structure your policy, is the mechanism by which you do that. So all these contracts with the major carriers will come with a benefit increase provision that is built into the policy. You do not typically pay for that provision. And what it says is that at typically every 3 years that you own the policy or at major life events, you have the ability to increase your coverage with financial underwriting only. So that means if you come out of training, you have a change in health, you're taking a new medication, you've had something come up, that does not hinder your ability to increase the benefits. Now, when you're taking that standard non-paid for version, you have a little bit of rigidity associated with it. So you have to apply every 3 years, or you have to accept it. Contracts will read differently. You want to know what that looks like, but you have this option to increase your benefits. The alternative is called a future increase option, where future increase options are going to put more flexibility into your hands. They're going to give you the same optionality, can still increase your benefits when you have an increase in income. It's not going to require you to do that on 3 year cycles. It's not going to mandate that you have to do it at any particular time, but you have that access. Now you typically pay for that latter version. Okay. So these are kind of the specs. This is the standard. Now, this is an example for a 34-year-old male. So put a little asterisk next to that. Not everybody on this call is a 34-year-old male. I can probably guarantee it. But I did want to give an example of what these things look like if you go for that full $5,000 a month benefit. So these are the five big carriers that we typically work with and that we typically see. So Ameritas, Guardian, Mass Mutual, Principal, and the Standard. Okay. Now, what's important to note is for podiatry, Principal categorizes you as three M's, which I don't expect that to mean anything to anybody. But what it says is that you're effectively lower risk by the way that they measure it. And so the rate is materially lower. Okay. Now, this could be a very good option for many people on the call. Okay. You want to go through the definitions, but you want to understand like this is kind of the range. So it now, if you're younger, premiums are lower. If you're older, premiums are higher. If you're a woman, premiums are higher. So women have higher claims experience for disability, and therefore the rates are going to be higher for females than they are for males. But again, this is just designed to give you an idea of if you're looking into this, what's the range that you're potentially looking at. Now, I mentioned earlier, if you're looking at these numbers and you're saying, wow, that seems like a lot of money for me right now, that's a reasonable thing to say. I think it's worth it, number one, but you can also scale back your initial benefit to get yourself in the door with these policies. And then you're leaning on the benefit increase option. Why you do that is because you don't want to have a change in health that precludes you from getting quality coverage later on, that you could have otherwise avoided, right? So you start at 2,000 a month and then you upgrade when you're in your attending. Okay. Um, so that's disability, right? That was a long explanation, but I think that's important because again, there's so much misinformation, so much bombarding of irrelevant information that I want everybody to really understand how does that work and what you want to look into. Okay. And then we're obviously happy to help should that be something of interest. That said, as we kind of move through the insurance spectrum, we have life insurance, really important if you have financial dependence. We have disability insurance, important for pretty much everyone. Okay. Then you have things like umbrella coverage, which not everybody knows what this is. So umbrella coverage is a subset of property and casualty. Your homeowners or renters and your auto policy, and it's liability protection. Okay. Now, during residency, you may not need this, but as you transition to attending, this becomes really important because what happens is, as a physician, you are at higher risk of being subject to a lawsuit, right? You get into a car accident, somebody Googles you, they see doctor, what's the assumption? You got a lot of money, whether that's real or not. That's what is being, that's what they believe. And so you need to protect yourself from those sorts of things. We had a client not too long ago, a doctor out of uh, Georgia. She was driving on a windy road at night. It was raining up a mountain, right? Uh, there's a motorcyclist coming in the other direction. She hit him. He died, right? That was a huge to her, not something that was going to be covered by just her $300,000 of auto policy protection. So the umbrella policy sits on top of this for additional liability. It's sold by the million. It's very inexpensive, relatively speaking. $1 million of umbrella coverage is probably $400 or $500 a year. Okay. So coming out of training, this is something that you want to have because, again, accidents happen, they might be your fault, and you don't want to lose, your everything you've kind of worked for or put yourself in a jeopardized position because you didn't know or didn't pursue this relatively simple thing to put in place. So umbrella coverage, important. You probably want to buy 1 million or 2 million kind of right out of the gate to get yourself a foundation. And then you typically want to match it with approximate net worth, right? So if you accumulate assets, all of a sudden you're worth $5 million. Well, that's your amount at risk, right? So you want to have umbrella coverage that protects you from lawsuits up to that amount. Now, in this vein, Colin touched on this at the beginning about like real estate, right? Which I think is a pretty popular investment tool among physicians. Maybe not something you own right now, but when you accumulate real estate, if that becomes part of your financial plan, you want to make sure that you're titling that stuff the right way, right? Because you don't want your entire net worth to be liable on a claim that happens in a rental property. So just to kind of fast forward to the punchline here, if you have rental properties or if you are pursuing rental properties, it is highly likely that you want to own those properties in an LLC. If you own multiple properties, you want to have each property owned by its own LLC. That limits the liability to what the LLC owns. So if it only owns a property, you can only be subject to liability up to that property value. If you have two rentals, you don't want somebody to slip and fall in rental A and sue you for the value of rental B. Okay. So things like that, you want to work with an attorney. I am not one, but this is stuff that you want to stay attuned to. And I think it points to the value of kind of having webinars like this where you're exposed to these ideas where you don't have to remember Matt said, I've got to put my property in an LLC. You've got to remember that Matt said if I own rental properties, there's legal protections that I want to pursue, right? And then you go ask us, you ask your financial planner, you ask your attorney, what should I be doing here? Now, the last thing I'll say on the legal planning side is basic estate planning documents. Okay, again, not always a priority during training, but it probably ought to be because you never know when things are going to happen, particularly if you are, married or in a relationship. So basic legal package is typically going to include a will and your healthcare documents, right? Medical directives, healthcare proxies, etc. Um, Now, in a perfect world, you go to an attorney, you have them drafted, you update them every couple of years. That's not necessarily going to be realistic for everybody. So there are solutions sometimes offered through work, offered through LegalZoom. We have access to a platform called Life Plan. It's basically free estate planning boilerplate. So not the perfect solution, but better than nothing. Free boilerplate healthcare directives, wills, etc., that you just need to get notarized. So I would strongly encourage you to do at least the free version or the low cost version of this stuff because, you know, you never know when something's going to happen. You don't want to be the person at the hospital who doesn't have these things set up and all of a sudden it becomes a fire drill to get signatures and have your information released to the people you want it to be released to. Sorry, the life insurance, disability insurance, umbrella coverage on top of regular P&C, and then legal documents are going to be kind of your basic protection package. That's your foundation. Okay. And I should pause for a second. I'm going to pause for a second. If there are, I'm trying to see where well, if there are questions, I'll encourage you to use the text chat, which I think you have access to, and I'll answer them as best I can while we're talking. But I'll just kind of run through because I don't see any questions yet. So if there are questions, please ask. Now, moving through the rest of this foundational component, you have your emergency fund. And I'll kind of pause to say during residency, I will double down on what I said earlier. There's only so many dollars to go around. You can only do so many of the things on this page towards your financial future. The things that are realistic, getting your insurances is realistic. Beginning an emergency fund is realistic. Taking advantage of your employer match if you have one is realistic. And then for some, contributing to a Roth IRA is realistic. Most of the time, that's about as far as you're going to get. If you can do more, that's great. But that's where I'm going to spend some time for the last, we'll say 10 or 15 minutes of this, and then we will open it up to Q&A. So, emergency fund. You don't need to fully fund an emergency fund during training, during residency, right? Not realistic, not necessary for most people. Your emergency fund will change as your lifestyle changes. So, rule of thumb, 3 to 6 months of, I'll say, basic expenses, right? Not your vacation fund, but how much does rent or mortgage cost? How much does your insurance cost? How much does your food and gas cost, right? Those sorts of things. So you want to take that, multiply it by 3 or 6, depending on how conservative or not you are. And that's going to give you an idea of what your emergency fund should look like. Now, if you enter a career path that has high income fluctuations, you might want to have more than that. So we have some clients who are self-employed. They have 12 months of an emergency fund. But this is something that you want to establish. It's safe, it's liquid, it's a money market account. It is, by definition, not super high performing, but it's going to insulate you from periods of unemployment, underemployment, or unexpected expenses. Now, your expenses are going to be different now than they are when you're in attending, right? So if you're spending X, $3,000 a month on basic living expenses now, or 5,000, whatever your number is, my guess is that you're not going to be spending the same number when you become an attending, right? Your lifestyle will change. So you need to make sure that that emergency fund shifts with you. An emergency fund is something that will stay with you almost your entire financial life, right? And the only thing that will shift is how big or small it is based on how much you're spending and then how much you have in other assets to backstop it. Okay. Now, employer matches, I think, are really important to address. During training, Roth contributions are going to be the most appropriate version of savings for you. So if you have access to a Roth 401k or 403b through your program, you want to contribute to it. Okay. Now, when you contribute to it, if there's an employer match, the match will go into the pre-tax account. So employer match dollars are always going to be pre-tax, but you, if you have the choice, want to make your contributions to a Roth account. If your program doesn't offer that, you would obviously contribute to the regular pre-tax version to get your employer match, but you wouldn't contribute more than that to the account. The only exception would be if your plan, and this is really rare, if your plan doesn't match the contributions to the Roth, um, then you would change your plan. But Roth contributions are really important. If your plan doesn't have a match, you generally don't need to take advantage of the 401k or 403b being offered. You might jump straight to a Roth IRA. Okay. Now, 60 seconds on why. Why are Roth contributions better during training? Um, Roth versus pre-tax. So let's start there. Pre-tax contributions give you a tax benefit today when you make the contribution. So you put money in, you get a tax deduction now in the year that you make the contribution. The money grows and grows and grows. And then when you take it out in retirement, that is taxed as ordinary income. A Roth says you're going to put money in after tax. There's no tax benefit to you today. The money grows and grows and grows. When you take it out in retirement, it is tax free. So we are choosing which version of ourselves are we giving the tax benefit to. And so you want to give the tax benefit to the version of you that's in a higher tax bracket. And I think for most residents, you can probably safely say that this is the least amount of money you're ever going to make, right? You should be in a higher tax bracket when you retire than you are today. So 9.5 times out of 10, we want those Roth contributions because you don't need a tax break today in a 12 or 22% bracket. You need the tax break 30 years from now when you're in a 24, 32, 37% bracket. Okay. So that becomes really easy. Now, as you transition through your career, that calculus gets a little bit more nuanced where you might be near your peak earning years. You might think, hey, I'm not going to be in as high a tax bracket when I retire. And great, that's potentially true. You make those evaluations based on your situation over time. But for right now, Roth contributions are going to be, kind of the go-to for everybody here. And then the last thing, within this first tier of planning is high interest debt. So high interest debt is generally defined as anything greater than 8%. If you're being charged 8% or more, that would be considered high interest debt by most definitions. Now, the first step here is try not to take on high interest debt. So try not to, have credit card balances that are rolling over. Try to avoid a car loan that's at 8 or 10 or 12%. Um, Now, in instances where that's either already happened, right? Can't change what we already done, or unavoidable for whatever reason, you want to make sure that you prioritize paying down your high interest debt before you pursue any other investing endeavors. Paying down debt at 8% or 10% or 12% is the equivalent of earning 8% or 12% or 10% on an investment account, but it's guaranteed, right? So if I have the choice between investing, really clear example. If I have the choice of investing in the S&P 500 that is earned 10% long term, but doesn't always go up, case in point right now, or paying down debt at 10%, I want to pay down the debt because it's a guaranteed 10, whereas the S&P 500 is something I've got to buy and hold and hope that I have it long enough to earn that return. Okay. So I think that kind of covers the foundation. So just to sort of recap quickly, and then we'll open it up for Q&A. Insurance protection, foundational. Life insurance, disability insurance, those are things that you get during residency if they're relevant for you. Umbrella coverage is something you want to pursue very shortly after transitioning. Emergency fund, 3 to 6 months of expenses, maybe more if we're going into a more entrepreneurial role, or if we just have a higher risk aversion. Taking advantage of your employer match, right? Contributing up to that amount. Any excess contributions would probably go towards your Roth IRA. and then avoiding or paying down high interest debt, right? Those are going to be kind of what this session is designed to bring to the surface for you and give you something that says, hey, I can build on a strong foundation. Okay. So with that, I'm going to pause. I'm going to open it up for questions and just kind of see, what else we can cover for our remaining time here tonight.
Man, I got actually a question regarding umbrella coverage. So I think it's kind of important to remember too with, and correct me if I'm wrong. So does umbrella liability coverage or personal liability, are those covering LLCs, or do you have to open up a policy that is more of like a commercial coverage? Like does like a
So
personal liability, umbrella liability cover LLCs like that you open up for real estate property, or is that a different type of umbrella coverage?
so that would depend on how you structure your LLC. It's typically going to protect any claims that are made against you. When the property is owned in the LLC, that's going to be separate because now it's
Mm,
not you as an individual, and that's why you
right.
did it. So you may have a separate policy or a separate liability contract that the LLC then owns. We don't often see folks taking that additional layer of protection necessarily. We're more trying to remove the property from our personal liability coverage. But directly to the question, that would typically be something that would be covered separately because you're separating it for all of the purposes,
Mm.
both protection and liability wise. Great question. What else do we have? Let's see. Oh, I found the Q&A. Um,
Yeah, looks like we have one from Dr. Rukas. Great presentation, he says. Thank you, and ACRA for providing this opportunity. Oh, it's more of a direct comment. Never
yeah, so I'll
mind.
take it. Thank you.
Yeah,
Thank you. But yeah, what else do we have on our minds for this evening?
actually, I have another one really quick. I mean, I'm just going to take advantage of all the free advice that I'm going to get because I have a lot of
There you
questions.
go.
Um, but so at what asset level do you think umbrella coverage becomes essential rather than optional?
Yeah, I would say it probably about assets probably about 500,000. It was where I would say definitely 1 million. Um,
Okay.
and the reason for that, and it kind of goes back to that same concept of particularly when you're early and then mid-career, like you've
Mm,
gone through the trenches, you've paid down the student loans, you're finally saving some money. You don't want something preventable to unwind and you go from 1 million to zero and have to start over again at 40 or 45. So you certainly want to have, as soon as you start to accumulate any assets, you really want to have it. But 500,000, I would say, is like, hey, I've put in enough work that I don't want to have to do this again.
mm. Yeah, I had someone actually um, bring that topic of like, just common pitfalls and mistakes that they've made. And I think like underinsuring, and then even, when you have kids and you have like teenage drivers, I think having an umbrella liability coverage is really crucial, right? It's something you don't really think about, but those are extensions of you, right? So,
Yeah. I think that actually, I'm going to just double click on what you just said and we'll wait for any additional questions that come through. I think what happens for almost everybody that we work with is it's not necessarily that people don't know. Sometimes people don't know, right? Sometimes people have never heard of umbrella coverage. But a lot of folks are just like the ones on this call where we're getting the education, but then life happens, right? And you slip into your attending role and it gets busy,
mm,
right? And then you have kids and that's pretty busy too, right? And so you're not thinking, oh, I've got to call my finance guy and make sure that I'm up to date on my umbrella coverage or my liability protection or my life insurance or any of those things. And then they slip and it's 2 or 3 years later, and now something's happened. right? And whether that's something catastrophic or whether that's something minor, it's just the presence of mind to come back to your finances at regularly scheduled intervals so that it's not reactive to something happens, I've got to reach out. I've got to do something. So that just kind of crossed my mind the way you phrased that. I appreciated that.
Yeah. We have
Yeah.
another question regarding liability. How to limit liability exposure from any lawsuits against spouse? Separate umbrella policy or same umbrella policy?
Oh, okay, good question. So a couple different ways you could approach it. So oftentimes you and your spouse can be protected under one umbrella policy. Now, if your spouse has accumulated significant assets and things like that, you might want to have more so that it's adequate to cover each of you. And umbrella coverage is like liability protection level one. Okay, so level one, which is adequate for most people. Level two would be you may want to start putting some of your personal assets in LLCs that you are not the sole owner of. So, if your spouse has accumulated a lot of assets, you might want to put some of those assets in an LLC where you and your spouse own a majority share of them, but you have another stakeholder that is a minority owner, and that limits the liability for everybody involved. Um, and then, level three would be like irrevocable trust planning and things like that, which is typically more than most people need. Um, but again, directly to the question that Dr. Daniel has asked, you're often going to be covered under the same policy when it comes to umbrella specifically. Okay, we've got another one.
Mhm.
Yeah, okay, so appreciate that. So yeah, umbrella coverage is not liability for malpractice. Okay, so really good distinction. Umbrella policies sit on top of liability that would otherwise be covered by auto or home. So these are car accidents, somebody slips and falls on your property. We had a doctor whose dog bit, so that was a liability claim. But this is not malpractice. So yes, appreciate the distinction and kind of bringing that to the surface. So
What are
what
your
would
thoughts on when to discontinue disability insurance, right? So when you become financially independent, your assets and your passive income streams sufficiently cover your living expenses, right? And you're no longer kind of relying on that active income. And so maintaining disability insurance could seem kind of redundant. Um,
Mhm.
so thoughts on, discontinuing that when you feel like you and your family have reached financial independence versus waiting that out until what, usually age 65.
Yeah, for sure. So yeah, probably not going to keep it to age 65 for most doctors. Now, the way that I would answer that question is it's not when you feel like you've reached financial independence, it's when it's a spreadsheet thing. Like this is one of those, like
Mhm.
finance is not all math, but some of it is. And so if you can financially afford to retire, then you likely do not need disability insurance anymore. Okay. Now, there are some going to be some exceptions to that might cause you to keep it longer or drop it earlier, right? So you might say, I have built up enough wealth where if I became disabled and could no longer work and contribute to my retirement accounts, I would experience a drop in lifestyle, but it is one that I am willing to accept as a consequence to dropping my policy. So that's part of it. Some people do keep it a little bit longer than they need just because they maybe don't want it to
Mhm.
be close. They want to say, listen, I'm going to work from age 45 to 65. I've reached financial independence at 52, but maybe I'm going to keep my disability policy until I'm 60 just because I'm otherwise going to earn the income. Why would I not have the insurance company protect me for it? Now, the other thing that we see is you scale down your disability insurance because what can happen is just kind of talking about the not the average, but a common life cycle is you come out of training, you're making your, real, I don't want to say real, but your elevated income. Your lifestyle starts to adjust to that, right? You're going out to dinners more, you're taking excuse me, vacations, you're spending more money because you have more money. You take on a mortgage, right? Because you want to buy a house. You maybe got a nicer car, and you're paying down your student loans. And so what happens is your expenses are comparatively high at that time. Then what happens is you pay off your student loans, an expense goes away. You pay off your car, an expense goes away. You pay off your mortgage, expense goes away. So now that protection that your disability has to cover goes down. And so we kind of see this working in a bell curve for a lot of people where your need goes up, 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 up. You've got this peak, usually in your early to mid career. Then you might say, listen, I don't need to drop the disability, but I can afford to reduce it and come back down to 10,000 a month instead of 15 or 20. And then you drop it later on. But I think it's a mathematical informed decision based on your actual lifestyle and how much coverage you're carrying. Yeah.
I think
Good.
this once again, and you mentioned it so many times, but it's, for those of you who don't have a disability or you're looking to get in one, please, please, please make sure you understand the definition of the term, of the definition of the any occupation and own occupation. I remember shopping around for that. It seems like superficially things that coincide with one another, but it does not. You did a great job explaining that, but and I think even more so, kind of looking at groups and individual policies. Matt, is there any kind of or can you explain potentially like why someone that could have a group policy with their employer may still need an individual policy?
Yeah, absolutely. A couple of reasons for that. So when you look at group coverage, well, one, group coverage is oftentimes at no cost to you. So you're going to have group coverage, and that's great, right? We don't want you to necessarily replace your group coverage with private. When you have group coverage, there are a couple of things that you need to be aware of, though. So, number one is most group policies are made for the entire organization. And so, what happens is those don't have specialty language for physicians. They've got very generic definitions that are not generally going to be very generous to you. So probably not going to have own occupation. If it does, it's probably for a limited period of time. Probably not going to have great partial disability definitions included. So just the definitions is going to be one reason. Now, the other reason that people typically carry both is group coverage is often going to read something like this. You are covered for 60% of your base income up to $10,000 a month. Okay. Now it could be 50%, could be up to 15, could be up to 7,500, fill in the blank. But that language is almost always going to exclude uh, incentive compensation, RVUs, anything that's not a salary. That definition doesn't necessarily capture. So you might not be protected for 60% of all of your income. You're 60% of some of your income. And then the other thing is depending on how much income we're making, we might be getting capped out at the dollar threshold that the employer is offering. So 60% up to 10,000 is going to say, well, if I make $400,000, I'm capped at 10, I'm not getting 60. So the private coverage is going to kind of fill that gap for whatever the difference between the group coverage is and what your actual coverage needs are. And then the last thing about the group coverage that you want to stay conscious of is when your employer is paying for the coverage, meaning it's free to you, the benefits are taxable when received. So if you're getting that $10,000 a month maximum, you're getting taxed on that amount. You might only walk home with 7,500, and that just kind of highlights the supplement that you would need through a private policy. Private policies, when paid for with after-tax dollars, which they all are, those benefits are received income tax free. So I would say it's a benefit amount thing. It is a taxation thing, and it's a definitions thing for why you are supplementing your group coverage with private. Yeah. Um,
Thank you.
yeah,
Yeah,
we
one
also
more
have
question.
a question comment about emergency funds. So I think this is a really great. So it says, can you touch base on where to start an emergency fund or a rainy day fund? And then he goes on to say, some folks might be thinking about investments or speculative accounts or Bitcoin or things of that nature. And I think that's a really uh, prudent distinction. Your emergency fund is not, it's intentionally low performing. Okay. It's not supposed to be a growth vehicle beyond what is reasonable. And I'll go over that too. So when we think about an emergency fund, this is not Bitcoin. This is not a Robinhood account. This is not the S&P 500, right? This is not a broad investment portfolio. This is money that is there regardless of what's going on in the world. Because what you don't want to happen is to have a period of underemployment or a large expense, and your emergency fund was invested in the S&P 500 in 2008, and you thought you had 70, and turns out you only have 40, right? So when you're looking at your emergency fund, some people will just keep it in the bank. Okay, that's fine because it's easy and it's better than not having one. The more optimal places that we see folks keeping their emergency fund are either high yield savings accounts. So Marcus, Amex, High Yield Max, there's a bunch of different services that will offer a savings account that is liquid and typically FDIC protected, but it'll yield in today's environment typically between 3 and 4, 4.5 or so. So you'll get a little bit more than what you get at the bank without exposing yourself to more risk. The other version of that would be a money market account, which you can open up through a brokerage account and just have it be a sleeve with other investments that you may have. Or there are money market funds. So you can buy a fund. If you buy a fund, you are giving up the tiniest bit of liquidity because you technically have to sell the fund and it can take a day to settle, but typically not a big enough deal to not pursue it. So you can ask about high yield savings wherever you bank. You can add an online bank solution, which would be like a high yield max or a SoFi, I think has a high yield account. Or if you already have an investment account, you can typically buy a money market within that investment account, and that can serve as your emergency fund. Um, but that again, really, really good call out for that because you don't want it to be uh, aggressive or something that may not be available to you when you need it.
Perfect. Yeah, I think that kind of concludes our hour. Um, I don't see any other final thoughts, questions. No. Um, any closing remarks, Matt? Anything you want to leave the audience with?
No, I mean, I think appreciate the time. I hope this has been helpful. I will make the waterfall piece available to ACFAS, and if anybody needs it or wants it, well, I guess I'll work with ACFAS to figure out, but we have that accessible to anybody who needs it. So we'll figure out the best way to get that out to you if you want it. But again, hopefully this has been helpful. Um, we want to make sure that these are informative and relevant. So whatever we can do to make that more so, please let us know if there are topics that we are not planning to cover that you want to be covered. Please communicate that some way to us. And then obviously we are available to answer any questions in a one-on-one format at no cost in support of the ACFAS community. So please feel free to reach out should that be the case and you just want to dive deeper into your situation.
Perfect. Just as a reminder, guys, this is one of four sessions that we'll be hosting throughout the year. So, yeah, stay tuned. We'll have transitioning to attending, student loan strategies, and we'll kick off the last webinar with Roth IRAs and benefit enrollment tips, along with long-term wealth building. So, hope you enjoyed the content. We'll hopefully make it available soon for our members. And then once again, thank you again for tuning in.
Thanks, everybody. Thanks, Colin.